now? Yeah. Good. There apparently was supposed to be somebody introducing us, however, they're running late, so we're just going to get started. My name is Matt Latham. I am a tax manager at Costerisan. I've been there for about a little over 6 years now. This is my 7th tax season, or the fun time of year for us, as we like to call. I'll have Ed introduce himself when he gets up here and talks. Basically, I will be here to talk about the Michigan tax changes that have happened. I'm sure some of you, if not all of you, have heard through the news that there were quite a bit of changes over the last year. So we're just going to walk through them. Hopefully, I'm sure there's something here that's going to apply to everybody right now. If not, it's going to apply to you eventually. So it's good for a nice little refresher. This is my favorite slide of the day, and unfortunately it's the first one. This one basically says, whatever I tell you, you can't trust me. You can't use the tax saving advice. So just get that out of the way. Back last spring, in May, Governor Snyder signed into law 2 House bills. Numbers are right there. If by chance you can't sleep at night and are really, really curious or just want to fall asleep, you can email me. I'll send you the bills. The law went into effect January 1 of this year, so it's in effect now. And basically, it did a couple different things. The first thing I'll talk about are the business tax changes. I don't know how many people here actually filed a Michigan business tax return. Basically, if you are a C corporation, if your business is organized as a C corporation, you are still taxed under this new law. If you have any other type of tax structure, single member LLC, so if you file a Schedule C under 1040, partnership, S Corp, you are no longer taxed by the state of Michigan, at least directly for business tax purposes. So one thing the governor and the legislature wanted to do was they wanted to simplify the tax law. And I joke as a CPA, usually when government gets involved, no matter what they say, it's job security for me because they really don't simplify it. This is probably the first time that I've seen where it actually did get a little bit easier. But there are still some caveats that we'll go over. So basically, you file a Schedule C for a single member LLC, state of Michigan, as far as they're concerned, you don't exist. If you are a C corporation, by chance, get out. No. Basically what the state did, I don't know how many people here actually have filed a Michigan business tax return. Okay? What they did, the Michigan business tax return has 2 components, the gross receipt tax and the business income tax. What the state legislature did was they got rid of the gross receipt tax. They basically they kept the business income tax. Instead of a 4.95% plus the surcharge, they just went with a flat 6% rate, which basically is the business income tax on the MBT once you include the surcharge. Your starting point is federal taxable income. There are some add-backs, there are some subtractions. The biggest add-back is bonus depreciation still. If by chance you bought a piece of equipment for your business, expensed it through bonus depreciation, you would still have to add it back. Here are some subtractions. The biggest one I see is actually the oil and gas subtraction, which I don't think is going to apply to anybody here, but basically the state says if you pay severance tax through your oil and gas properties, you're not subject to the Michigan business tax. And that's been in the law since the SBT was around. Credit changes. Yes?
With the depreciation, bonus depreciation, will you still just take the regular extended depreciation?
Yes, you can. You can still take regular depreciation. Basically what the state has said is you're still allowed to depreciate the property. I would say though that if you can, take section 179, because that's not an add back, you still get to expense it. The difference between the two, section 179 you can use for new or used property. You have to have business income to be able to take it. If you don't have a profit, you can't take it. Bonus depreciation you can take regardless, but it just has to be new property. You can't take that on used property. So from our perspective, Section 179 is better, then you avoid the whole state add back. Credits, this was part of the simplification. I forget how many credits there are under the MBT. There are so many credits, and some of them have cute little nicknames because they literally apply to about 2 taxpayers. There's like the Meyer credit. It's not the actual name of it, but it's pretty much Myers. I guess Kroger would probably qualify for it. It's really interesting to see the businesses that qualify for it just because you know who had the ear of the legislature. Governor said no more. We're going to get rid of all the credits, or pretty much all the credits. There's a but there. The first but is the small business credit is still in play, which the legislature wanted to give small businesses a break. Same as the MBT, it hasn't changed. So if your business income plus any wages that you might take in, any benefits, if it's under $160,000, you get the full credit. If it's over 180, you don't get it. If it's in between, you're in a special phase-in. If by chance you have more than $19 million of gross receipts, you are starting to get phased out of the credit. Or if by chance your adjusted business income, which is basically your federal taxable income, plus any wages any corporate officers would get. If that's more than 1.3 million, then you also don't get the credit. Yes?
Does the 160,000 on the wages and benefits, does that apply in aggregate, or is that the idea that you shouldn't have anybody over that and you're going for that? By individual or by aggregate?
It's by individual. So you look at each individual shareholder. If by chance you file a unitary return, each entity is tested on a standalone basis. The problem is if you have one entity that disqualifies you, the whole unitary group gets disqualified. And even there, it's done on an officer by officer basis. So the gross receipts and the business income, the adjusted business income side, that's done in aggregate. The other caveat here is by chance if you're a fiscal year taxpayer, you have to annualize your income when you have a short period return, which I'll get into in a minute, because I'd like to say the state doesn't learn from their mistakes. The big but with the credits is if by chance you get one of these credits specifically listed here, the biggest one that I usually deal with is the mega credit. These are credits that the state has to certify. The state basically agrees for the next 15 years you get this credit. One of the problems was when the governor said we're going to get rid of everything, all these businesses went, wait a second, we have this credit that we got in 2005, or started in 2005. You said we were going to get it for 10 years. Now all of a sudden you're telling me you can't. Well, the state compromised and said, we're going to give you the credit, but you have to elect to file under the MBT. And basically what you do is you compute your tax under both laws. Whichever one is higher before the credit, that's the one you pay. And then you're allowed to take your credit. So for pretty much all taxpayers that have these credits, it's going to be better to file under the MBT. Once the agreement expires, say you had a 10-year agreement that started in 2005, so 2015 is the last year. In 2016, you're going to file under the new law. The unitary group concept that was so popular under the MBT and kept me awake at night has stayed. It's the same as the MBT. One thing that happened with the transition that we talked about was that the state didn't really give us much guidance on how this works. And they kind of brought the unitary concept over from California, which makes us all frightened whenever they decide to pull anything in tax law from California, because California is just a goofy state when it comes to tax laws. So pretty much the first year we were filing returns, we had no guidance from the state. We were left to interpret the law. 2009 rolled around, the state finally came out with some guidance. Whether we were right or wrong, we had to go back and fix what we did, which kept us really, really busy, made for an interesting couple of years. Unitary concept's the same. Pass-through entities, though, which said we're not subject to the new tax, you're not going to be pulled into a unitary group. This is just dealing with C corporations. The one caveat is if by chance you are part of a C Corp and a pass-through entity, if the C Corp is a partner in the partnership, your pass-through is going to get indirectly taxed based on this little formula. Under the Michigan business tax, if your taxable income was $100,000 and then included $40,000 of pass-through income, you were allowed to subtract that out. Under the new law, that subtraction doesn't exist. So if you have the same $100,000 taxable income, 40 of which is still from pass-through income, your tax base is still $100,000. So that was one thing the legislature didn't add. So it's kind of their way to, I guess indirectly tax pass-throughs. Transitional issues. I joked, if you're in a C corporation, get out. It's not quite that simple, but some of the transition issues to consider. If you do file an MBT return and you haven't done your 2011 return yet, if by chance you're going to be subject to the new tax law, there is no loss carry forward. That's what we like to call a budget plug. What were most Michigan businesses doing in 2007, 8, 9, well, 2008, 9, and 10? They were losing money. What are they doing now? They're turning around, they're making a profit. Guess what that's going to be just in time for? This new tax, and all of a sudden, you had $1 million loss carry forward, you don't get that anymore. So you have $1 million of income in 2012, instead of having a tax base of 0, you have a tax base of $1 million. That's a subtle budget plug that didn't get any attention, at least from the press. So we've been telling clients, does it make sense to utilize losses? If you're going to be subject to both taxes, does it make sense to take bonus depreciation in 2011 or Section 179? Force yourself to recognize income in 2011. Utilize the loss on the state level. Now you got to be careful with that, because with any good state tax plan usually means it's very bad federal tax planning. And if you think about it, if you take the highest rate, highest individual rate, 35%, or highest corporate rate, 35% in the federal tax code, does it make sense to save 6% to get tagged with 35% in the federal? Well, maybe you don't like the state that much, but to me, it doesn't make much sense to do that. So you got to be real careful with that. Fiscal year concerns. If you're a fiscal year filer, this was another thing that caused a lot of headaches from the SBT to the MBT. They said fiscal year filers, you get to file both returns. Now, I'm a logical person. I think it makes a lot of sense to say for 2011, whatever your tax year ends, you're going to file a 2011 MBT return. And once your tax year goes into 2012, you'll file the new return. Well, the state decided that we love doing it so much the first time, they're going to make us do it the second time. So if you're part of a C corporation that has a June year end, you're going to file a 6-month July to December MBT return, and then a 6-month January to June corporate income tax return. If you have a unitary group, it gets a little stickier than that. Basically, actually, thankfully, the state's come out with some guidance. If you're part of a unitary return, and this is going to get a little complicated, that your designated member, okay, has a fiscal year end, and you have like a calendar year end client, excuse me, flip that around. Your designated member is a calendar year end, and you have a fiscal year corporation within that return, say it's June, okay, your unitary return would normally take your December 2011 designated member, your June 2011 corporate member. Well, with this new transition, the state's telling us that you have to file the calendar year designated member with the June year-end corporate member and include a third entity with the December year-end corporate member, which kind of surprises us because we actually thought that was a logical way to do it. It just was nice to finally get guidance from the state now and not a year from now, which is more common. Filing threshold, $350,000. It was like that under the SBT. It was like that under the MBT, except the MBT, you got a credit if you were under $700,000. The new tax, it's $350,000 again. You're fully exposed to the tax. The NBT introduced this idea called single factor apportionment, meaning if you just take your sales, if you just had Michigan sales, okay, and you have out-of-state sales, you only have to bring in your Michigan sales, and that's the percentage over total sales that you are exposed to the tax. They've decided to keep that. On the federal side, I joke to get out. Should you make an S election? If you are part of a C corporation and you are eligible to make an S election, it's something to consider, and it's something to consider very, very quickly, because the deadline for making an S election is March 15th, okay? You can file afterwards, and as we like to say, get on your knees, and that's the IRS for forgiveness, which 99.9% of the time they do. They'll say fine. But it's something to think about. You also have to make sense, or have to decide if it makes sense for the way your business operates. And I imagine as realtors, most of you are a little busier in the spring and summer and fall than you are the winter. So it might make more sense to go ahead and make that S election, because you can do all the accounting for it in January. Maybe you're not as busy, with selling houses. Some things to consider. There's a built-in gains consideration. Basically, assets that you have in your company that have appreciated in value, you have to hang on to them for 10 years. If you sell them before then, you have to recognize what's called the built-in gains, or the publicly dubbed big tax. It's 35% for 2011. That's another thing to think about. If you know you're going to get rid of a bunch of stuff, does it make sense to make an S election again? All to avoid 6% on state taxes. Only certain people are eligible to make an S election, and this pretty much lists it all out. Ineligible shareholders, if there's a C corporation shareholder involved, you're not eligible. If you're a partnership, you're not eligible unless you're a single member LLC. You would be eligible to make an S election. And then again, just be aware of the federal rate. So oftentimes, yes.
Does one ineligible person, as far as making the S election, say you have 80 U.S. citizens and 1 Canadian citizen who are shareholders?
That would disqualify you. It just takes one. One thing I'll mention is that married couples count as one. So if you have 60 husband and wives, all as shareholders, that'll actually, instead of 120 shareholders, you have 60. So you do have that. That's the one exception where married couples count as one.
I hope I'm not splitting hairs. What if the husband's an American citizen, the wife's Canadian citizen? Does that disqualify them from?
Yes, that would disqualify him, because you do have to be a U.S. citizen.
Okay.
Now, if a Canadian citizen happens to have dual citizenship, that would be now you're getting a little stickier, but that could potentially be okay. And the reason why I keep mentioning federal tax impact is because my favorite phone call to get from a client is, guess what I just did? Or guess what I just heard on the news? It's like, okay, well, understand that what you hear on the news might be specific for certain people, or guess what you just did means guess how much tax you just owe. You really have to think it through and think about what your personal tax rate is. If it's 35%, if it's 25%, if it's 15%, 10%. You also have to look at C corporations. When they pay dividends, you're getting capital gains tax on those dividends. S corporations, you pay yourself a distribution. You don't have to pay tax on that distribution. You just want to be real careful with it, because that will raise a red flag with the IRS. They're really trying to scrutinize S corporations. If you have a federal NOL, it will freeze until you're able to use it. Now, if you have a built-in gains, you can offset the gain with that NOL, but corporations have a 20-year carry forward with NOLs, so it's something where if you make the election, 10 years later you disqualify yourself from like an invalid shareholder, you still have that NOL available to you. And so that's, like I said, just be real careful with the federal tax impact. Does it make sense to expose yourself to a 20% rate, save 6%? It might not. The individual tax changes, now this got probably most of the press, at least a portion of this, okay? The individual tax rate for 2011 and 2012 is 4.35%. The legislature was so kind to us, they decided in 2013 we get a break. It's 4.25%. That, I forget what the graduated rate was, or excuse me, what the rate was supposed to go down to for 2000. If they didn't, I think it was supposed to be 4.25% for 2012, and then a 0.1% reduction every year after. That again was kind of a budget fix. You know, they did. I mean, on the business side, just took all these businesses that are no longer going to be exposed to the tax. They had to figure out a way to pay for it, and that was one way the legislature did. They froze the tax rate at 4.35%. Much like the business side, the credit side on the individual is very, very different. Earned income credit was 20%, now it's 6%. Other popular credits, city taxes paid, public contributions, college tuition, although there are about 2 colleges that qualify for that right now, homeless shelter, food bank contributions, all those credits gone in 2012. The film credit gone, which was a big kind of press coup. Apportionment for individuals, single factor is being introduced. This is a change. The difference with individuals is you have to file in another state. If you don't, you can't take out your out-of-state sales. Businesses, you don't necessarily have to file in the other state. Here's a big one that's probably that should affect everybody in this room. The homestead credit is completely different. For 2011, and pretty much every year before this, you got a $1,200, potentially had a $1,200 refundable credit if your household income was under that $82,000, and that, for the most part, was just your federal AGI, with some differences. A lot of people qualified for it, okay? Well, the state has gone and done a couple different changes that were pretty big. One was they changed the definition of household income, and they're calling it household resources. Second is they put a taxable value limitation. So if your house that is valued at a certain level, you won't get the credit. Again, household income, pretty much what your 1040 looks like. Household resources, you take your AGI and you add back all your losses. So your Schedule C has a loss. 2011, you can take it and get the credit. 2012, the state says no, you have to add it back. If by chance you're still under the income level threshold, you still might get the credit. But as you'll see, the income level is quite a bit different. Instead of $82,000, okay, you're completely phased out of the credit if your household resources is over $50,000. And as far as I saw, I believe that was for everybody. Joint filers, single filers, if you were over 50,000. Joint, I might need to double check that. Joint could be 100, but still, it's much, much lower than what it was. Taxable value of your home. This is not assessed value. This is something to make the distinction. It's taxable value of your home. If it's over $135,000, you are not eligible for this credit. So that pretty much equates to an assessable value of $270,000. The credit's still $1,200. It's still a refundable credit. It's just, as you can see, $50,000 versus $82,000, $135,000 for the taxable value as opposed to nothing. Very, very restrictive, very, very limited. So that's something certainly to make people aware of, you know, as you're out, especially as you're trying to sell a house, somebody asks you about it. Deduction changes. For seniors, senior taxes were a very, very hot topic, and I imagine for this election year it will be too. If you were born after 1945, you, in 2011, get a deduction for all your interest and dividends that you received. 2012, it's gone. You don't get that deduction anymore. Personal exemption. is eliminated if your household income is over those two levels. 100 grand for a single filer, 200,000 for a joint filer. In 2011, you got an exemption if you were over the age of 65, that the state considers a senior. 2012, gone. Political contribution deductions, it's a popular one, although it's not much. You were allowed a $100 deduction on your state return. That is also gone in 2012. So you can see they're really trying to simplify it as much as they can. Pension changes. This was probably the biggest topic. There was a state representative that actually got recalled over this, first one in like 25 years or something. Basically, the state has decided to split us up into 3 age groups: born before 46, born between 46 and 52, born after 52. If you were born before 1946, I'm going to make your life easy. Absolutely nothing has changed. Public pensions are fully excluded. Private pensions, up to, if you're married, it's 92,000 something, are completely excluded. And this is where I like to say this. For some reason, my mom, being the CPA, thinks that I actually changed the tax laws. And my mom was a teacher, and she obviously heard that we were in tax public pensions, so she wasn't happy, and she called to talk spiritedly towards me about it. And I go, Mom, when were you born? And of course, she took that as her son forgot when she was born. Not a facetious, I know when you were born, Mom, I'm just trying to get you to answer your own question. She was born December 11th, 1945. So I said, you can thank Grandma, you were born 3 weeks early, nothing has changed for you. Now, if you're married and you file a joint return, and one spouse is born in 45, another spouse was born, say, in 47, the state has said, as long as you file a joint return, they will look at the age of the oldest spouse, as long as you file that joint return. Now, as soon as that person passes away or you get divorced, you will end up back in whatever age group you're in, which I've gotten this question before, so I just mentioned it now. At one time I had somebody ask me, does this mean marrying older is good tax planning? And I actually had I'll say a young lady who was probably about 66 come up to me and go, she goes, are you single? And I am. And I said, but I don't have any pension. I'm not drawing any pension right now, so it doesn't make sense for me. Sorry. I guess in a way, yeah, okay. It's if you dating somebody who happens to fall in an older age group, if that's what you want, go for it. But the state has said, and as far as I know, I don't even think it actually says that in the law. It's just something the Treasury Department has come out and said. So when the Treasury Department comes out and tells us something that's not in the law and we like it, we listen. If we don't like it, we'll fight it. So born before 46, nothing changes. If you're born in this middle age group, your Social Security will still be exempt. Your pension, however, whether it's public or private, will be fully taxed once you get past. You get an initial $40,000 deduction if you're married, 20 if you're not. Above and beyond that, what you withdraw that's taxable on your federal return, you'll get taxed on your state return. Once you reach the age of 67, instead of getting a $20,000 or $40,000 deduction towards just pensions, you get a $20,000 or $40,000 deduction towards everything that you bring in as income, and your Social Security is still exempt. Is that good, bad? I don't know. Born after 52, you have nothing is special before you turn the age of 67. Okay, Social Security is still exempt. Once you reach age 67, you get to make an election. You can exempt. You can take the $40,000 deduction, and you have to forego your Social Security exemption, or you can get the Social Security and personal exemption. Basically, if you fall in this age group and you happen to still be in the state of Michigan when you're 67, what you have to do is just look. How much money am I taking from Social Security? How much money am I taking how much money would I save under these two cases, which one saves me more, and make that election. Typically, when we get to make elections, we get a form or a statement to attach to a return. As far as we know, if this is something, whether you do or you're not, you're going to do it on the return, and the state's going to be able to figure it out. I'm not holding my breath on that one. Yes?
Is that election an annual election, or you decide it once, that's it for life?
As far as we can tell, it's an annual election. So every year you'll be able to look and figure that out. This slide is actually slightly outdated now. Probably could have taken it out. The law originally written said that if you earn too much income, they disqualified you from any of these deductions. Well, that got, actually Governor Snyder took preemptive, sent it to the state Supreme Court because he didn't want to get this challenge in court, now have it get delayed or have everything get thrown out and then have to be right back to the drawing board. So he sent it to the Supreme Court. The Supreme Court came back and said that this portion of the law, and only this portion, was unconstitutional. Most people don't realize it's unconstitutional in the state of Michigan to have a graduated income tax rate. Like federal, we have a graduated income tax rate. State, we have a flat rate. For that to change, actually the voters of the state would have to approve it. What the Supreme Court said was this $150,000 or $75,000 if you're single, what that did was it effectively created a graduated income tax. So the state threw out that exemption. So now everybody, regardless of how much money you make, gets these deductions. So that was just something, and that was, that actually came out, I think, right around Thanksgiving. I left it in here because it's still kind of relevant, because some people might think that there's some sort of phase out, but it's not there anymore. Okay. Other changes, and this is going to be, this is a big one, and this actually, we're a couple first 2 weeks of January don't really count, so pretty much a month into our tax season for this year. This is a big one that we're already seeing. Some of you, especially if, I don't know if any of you are already drawing pensions, may have gotten something from the state of Michigan that says you need to withhold. Well, you need to look at it carefully, okay? It's Form 4924. Not that that's obvious on the state returns, because those form numbers are about yay big. It's not like the federal returns. You can obviously see them by looking at a piece of paper. If you haven't gotten anything, contact your pension administrator, pension plan administrator. See what they're doing. We are assuming that they're going to default. If they don't hear anything from you, they're going to default you to 4.35% withholding on your pensions. So if you know you don't have to pay any state taxes, you really shouldn't be having anything withheld, you need to contact them and let them know. There are forms, like I said, this form, there's literally check a box, and you send it on to the pension plan administrator, and they'll be able to make the adjustments. Because that's something, for some people, it's a big deal. All of a sudden, you know, your pension has that amount taken out. You might be expecting it. If by chance you're in a partnership or an S corporation, you might have also gotten one of these notices. Flow-through entities are required to withhold, provided that you have either a non-resident individual shareholder or partner, or if any partner or shareholder is another flow-through entity, regardless of where that flow-through entity is located, provided that your company has earned more than $200,000 of federal taxable income. And as far as we know, I mentioned earlier how the state does not allow bonus depreciation. As far as we can tell, that also does not include bonus depreciation. You need to make that adjustment. If either of those two situations are true, you're supposed to withhold. For a non-resident individual, it's 4.35%. For a corporate shareholder, it's 6%. If you don't know if it's a flow-through entity that's a partner, and you don't know who the end taxpayer is, you're supposed to withhold 6%. Now, if by chance you're in a partnership and there's a partnership shareholder, or a partnership partner in that partnership, and you know everybody in all these partnerships are resident individuals, then you don't have to withhold. pretty much look at the end taxpayer, who's ultimately responsible for paying taxes, and that determines how much you withhold. Now, the one question I usually get is, what happens if we don't do it? If we should, but we don't? I can't tell you, because we don't know. In theory, your business could get penalized, and as a nickel's worth of free advice, when it comes to taxes, pay your state taxes, because penalties on the state are extremely high, especially compared to federal. We've actually had clients who have to choose, which do we pay, federal tax or state tax, and they have enough cash flow at the time. We told them to pay their state taxes, because those penalties are a lot less. Plus, the federal penalties are usually a little easier to wiggle your way out of. The state's not quite as forgiving. I mean, the state's in a budget crunch, so they're looking for money. On that note, the state is looking for money. This is something that may or may not affect you. It's something that we've noticed has come up a lot recently, is unclaimed property. Basically, it's anything that you paid, somebody comes and provides a service for you, and you've sent them a check, and that check has not been cashed. That would be unclaimed property. Insurance claims is a popular one. Basically, anything that just hasn't been claimed by its rightful owner after a certain period of time is called the dormancy period, and everything has their own different period for commissions, payroll, insurance claims. That's what they are, 1 year. Yes?
Is this only services? I work for a land developer, and occasionally we'll write a check for a township, and for a permit, we kind of hang on to it for a while, and then over the years I've had a couple that probably need to be voided. That would really be pauses, would it?
Yes, it would be. Or it could be, yes. And it's basically not, it's not just for services, it's for goods. So if you have, say, a piece of land, although that's usually something that comes through on like an estate or through a trust, that somebody is the rightful owner to, and they don't know it, you're required in all this case to report it to the state of Michigan. Now, you're supposed to make what's called a good faith effort to track these people down or to follow up with them. And if you do that and you report it to the state, there's absolutely no penalty. Because this isn't a tax. You're not going to get taxed on this. What happens is that if you have all these outstanding checks, and if you think about it, when you do your accounting and you have a cash reconciliation, what the state's doing is they've hired this outside firm, I think it's from New Jersey, to come in and audit all of these. And the first thing that I would do is I would look at your cash reconciliation and see what's there. If there's something there more than a year and you haven't reported it, they're going to add it. And the issue is going to be the penalties, because there's a up to 25% penalty of whatever value you haven't reported that the state can charge plus interest. And that's why I mentioned when you pay state taxes, if you can only pay one, state or federal, pay your state taxes first. Get out of the penalties. That way you don't have to deal with trying to ask for forgiveness. And it's kind of the same thing here, is that you're supposed to be reporting it. Now, it's everything that hasn't been claimed as of March 31st, provided that it's longer than these dormancy periods. Yes?
Is this both business and individual?
This would be business. But keep in mind, if you're a single member LLC, it could still apply to you. Yes?
Now, in the case I was talking about, it might be that we were just slow about voiding the check, we never did apply for the permit or something like that, and I just go ahead and void that check.
I would, and then you'll probably be okay. Because the one thing we've noticed is we got a lot of notices back in January. You had to report it by January 1st. Every once in a while, the state likes to say, you can come clean and we won't penalize you, and this was one of those times. And the thing was, it was really the form, we didn't like it, because it said you have to fill it out, you have to report everything that's unclaimed as of right now. If you don't have any, check this box and still send the form in. We didn't like that, because it's like if you don't have anything to report, you're not supposed to report it normally. And now the state's telling us all of a sudden we did, that we thought that would be like taking a giant red flag up to the Capitol going, look at me, come audit me. And actually, we got an email from the state bar that said, if you have no unclaimed property, don't file the form. It's like, that's not what the statute says. We're not sure why the state's trying to do that, other than they're trying to get a bigger audit sample pool. Yes?
This might actually affect a lot of people in the room. We have a real estate company also, and there's occasionally people who put money on deposit, because we also sell residential lots. And some of those deposits are 5 or 6 years old. They're still valid deposits though. Should we make an effort after, somebody hasn't actually bought a lot or whatever, we get that back from them, but it's deposited 2 years old?
I would say yes, that's something to look into, because that would potentially be unclaimed property, and I can imagine that could be a big number, depending on the amount of the deposit, and especially if something hasn't sold for a while. That would be something to look into. And again, it's if you report it, it's not doing it. I mean, it's money that's not yours to begin with, right? So you're reporting it to the state. You're not losing anything really, because you're not. I mean, it's not yours to begin with. It's somebody else's. And what that does is that it allows people. You can go to the state website and check: do I have any unclaimed property? And I can contact the state and be like, I'm the rightful owner, and go through the red tape to get it. But so there's nothing to discourage you from not reporting this stuff. Other than, I don't know, the state might wonder why you have, if you constantly have a lot of unclaimed properties, the state might wonder about your business, but that would be, as far as I can tell, there's nothing to discourage you from doing it, other than that people don't quite realize that this is out there. The filing reporting period, it's everything as of March 31st. You're supposed to report it by July 1st. I believe the old due date was November something, November 31st or 30th or November 1st. They've bumped that up here in the state. As I mentioned, some people might have gotten a notice just asking if you had any, we call it phishing, asking if you've had any unclaimed property. The form says if you don't, you're supposed to fill it out, say you don't, and send it on in. To us, that was a big audit risk, and not that, again, it's not that you're hiding anything, but why go through the headaches if you don't have to, because you normally don't have to report. You don't have to every year tell the state that you don't have any unclaimed property. It's not how it works. And then that's when we got an email from the state bar saying that they don't agree with what the form's saying. If you do have unclaimed property, you're supposed to file the form. If you don't, though, we pitched them. We said, no, thanks, but no thanks. Sales and use tax is the other real big issue. As you can imagine, the government hasn't kept up with the world of technology. How many people here buy stuff online? How many people here pay sales tax when they buy stuff online? If you buy stuff from Amazon.com, you do now. Basically, whenever you buy anything online, it's a good. It's like if you went to the store here and bought it, you're supposed to pay sales tax. It's technically the responsibility of the company to pay the sales tax. However, some of you may notice on your Michigan 1040, there's a spot called use tax. How much internet stuff did you buy? And could you tell us now and then remit the tax now? You laugh because we would tell clients, why would you voluntarily do that? How are they going to know? Well, it's actually going to be pretty easy for the state. And think about it, the state's in a budget crunch. It's an election year, so you're probably safe this year. But how hard is it going to be for the state legislature to go up to Amazon and say, we want all of your records of sales shipped to Michigan? If your name's on that, you might get a notice, you might not. And then the state's going to be, where's our tax? Where's our 6%? And that's what use tax is. The states, it's not just Michigan. It's pretty much every state in the union is trying to figure this out, how to do this. How many people buy software for anything? How many people use a cloud system online? That's probably the absolute grayest area of use tax. Like I said, states have not figured out what it is. And, yes?
If you have a back-to-back cloud, aren't they providing service that would be taxable?
That's the greatest of software and the cloud system. I would argue yes, but I'm not a state employee. We bring in somebody from the Treasury Department that they'll probably argue otherwise, or they might argue otherwise. It really depends on what you use it for. Yes?
Does that tax only apply if you make your internet purchase in Michigan, physically you're in Michigan?
That, what they're going to do is they're going to look at where the sale is shipped to, and it's going to be the end use of the product. So on that note, like if you bought it from a Washington company, came to Michigan, both states can't come after you for use tax. Washington would be more apt to go after the company than you. Michigan would be more apt to come after you than the company, but the states we're finding are trying to get more aggressive in this area because it's a huge source of revenue that they haven't figured out how to attack yet. They're just trying to get around it. I'll give you an example. It's actually more of a sales tax audit. But whenever we get a sales tax audit, they always tack on the use tax too. It was a company, and this is how the state keeps me employed. The company was very, very small at the start of 2000 and grew very, very rapidly by about the middle 2005-ish, to the point where it's now, where it's a lot bigger than it used to be. The state came in, and typically they're allowed to audit the prior 4 years. Unless you don't file a return or pay tax, then they can go back 10 years. They can go back further if they think you flat out been fraudulent. But with this particular company, for the first few years, they really didn't have any sales tax. We filed returns with zeros, just to, as we say, get the statute of limitations running. The state came back and told us that doesn't count. And we're like, said you have to pay a tax for the statute to run. And I think we were actually there with the auditor. We had the statute right in front of him and said, pointed to him and said, where does that say that? It says you have to file a return. This sales tax audit started in November of 2010. These typically last a day or two. You talk to the auditor for a day. You might go to an on-site visit to the company's site just so they can see what goes on there. They usually do what's called a utility study. They'll come back a week later, give you adjustments, you negotiate, and boom, you're done. This started November 2010. We just wrapped it up last week because of, well, one, the state auditor was incompetent. You can't say it any more nicely than that. Two, we decided to, we joked he was so incompetent, the state promoted him. So we had to deal with another one. It sat dormant the entire summer. And then finally, a new auditor contacted us. Well, the old auditor was going to argue with us, tooth and nail, that they could go back 10 years. The new auditor thankfully came in right away and said, oh, by the way, we're only going to go back 4. We can't go back that far. So we were like, thank you. You sent us somebody who knew what they were doing. So that was, for this company, it was huge. I mean, it probably saved potentially, even though I'm almost certain that if we went that far, we would have litigated it. The state was going to charge him, I think, an extra $100,000 was what he was projecting for going back past the 4 years. So it saved him a lot of money. They ended up paying about 20 instead of paying about 120, 150. So for them, it was pretty nice. And what they did was, what they do is they came in, they looked at all their invoices, and they're just, if you didn't pay tax, they'll ask you about it. Now, you might have a reason. You know, we bought something from a Florida company and it went to Florida, or it stayed in Florida. It never came to Michigan. Therefore, Michigan doesn't have the right to tax it. It was really a service. It wasn't a good, it was a service. It's just you can't tell from that, but here's the proof. And it's like, okay, well, that works. Or it was software, and it was just an intangible good. And that's where the cloud system gets a little murkier, because states have said if it's a general platform that everybody uses is what they're gonna look at versus if it's customizable. If it's general, you're probably gonna be okay. If it's something that they specifically customize for use of your own company and nobody else can use it, the state might come back and be like, no, that's a taxable good. Amazon.com just happens to be currently the most famous one. I forget how many states came after them, but there's quite a few, to the point now where Amazon.com is supposedly charging sales tax now on all their goods. I haven't bought anything from Amazon.com since that's happened, so I couldn't tell you for certain. Yes?
Was that 4 years of records that you had to keep for individual and business?
We will tell, as far as record keeping goes,
Yes.
we will tell you to keep tax records for at least 7. And then I know we will keep 5. Actually, most of our stuff is paperless now, so I imagine our paperless returns are going to be kept forever. But our paper files we actually keep 10. But even though you're really only supposed to have to keep them 7, we're just ultra safe. As far as being exposed, the reason why is just because the first thing any auditor will do, whether it's IRS or the state, is they'll try to come in and figure out a way to go back further than 4 years. Now, more the state than the IRS. It's going to sound really funny. IRS is actually easy to deal with. They're smart. They understand the value of a dollar. Most of their people are well trained. They know they want to get in and out. They actually do understand they're a nuisance in your life. They want to get in and out as fast as possible. The state hasn't learned that yet. The state will come in and nickel and dime you as much as humanly possible because they'll might take the attitude that a dollar here, a dollar here. You won't argue it. It'll add up to something eventually. Like kind of with this sales and use tax, this company, $20,000 wasn't a big check for them. 100 or 150 would have been, but 20 wasn't a big deal. They were ready just to get it over with. We still, actually, I think the original came back, it was, the original adjustment was 50,000, and the company was ready to write a check for that. We told them, no, we can get that down a little further, and we did. But, like I said, IRS auditors are usually pretty easy to deal with. They gotta go through their routine, their step 1, step 2, step 3, so they might be slow, but the state's gotta do the same thing. They go through their same processes, but we've just found that state auditors don't understand the value of a dollar. And I can actually, on MBT audits, this is something I'll caution those of you who have filed MBT returns. If you're not going to be filing a new corporate tax, your tax base is going away. This is just a guess. I'm not saying I've read anything that makes this true. The state is losing a huge tax base as far as income taxes go. I have a feeling they're going to aggressively audit MBT returns. They got 4 years of returns now, or they will have 4 years of returns as soon as this filing period gets over with, that they'll aggressively come after. Our firm in particular was somewhat aggressive when it came to materials and supplies deduction. You got a gross receipt deductions for any materials and supplies used to maintain inventory or fixed assets. For us, it costs us money, in return costs clients money for us to deal with what we need to figure out what they can take. You're talking about a 1% subtraction. You know, save $500 in tax, but it costs us $1,000 to figure out that $500. Most people here would say, no, I like you as a CPA, I just only get that much. So it's okay. Some people will. They'll come back and say, I don't want to pay the government anything. I'd rather pay you guys. But so there were some areas where we just went, okay, this is what we'll generally do. We let the client know. They're like, okay, that's fine. The state comes back and they'll fight. Actually, they won't fight. They'll just throw it out, is what we found. We had a restaurant client that we deducted uniforms under the claim that they need to wear uniforms to maintain their inventory. State auditors said, no, they don't. And the example that we gave them was, if you were a health, the Michigan Health Department came into their business and the employees were not wearing hairnets, they weren't wearing gloves, they weren't wearing proper attire, what would the health department do? If not shut the business down, tell them they got to discard whatever it is that they have because they're not properly handling it. It's not safe. Logical, right? Makes sense. Surprisingly, the state auditor went, I never thought of that before. I have to talk to my supervisor, which is our favorite response from the state auditor. I have to talk to my supervisor. They can't make a decision on themselves. It's kind of like when you ask your tax CPA a question and they say it depends. It's kind of that same answer. The state came back and still denied it, which the amount wasn't big enough for us to worry about it. We just threw that out there for them. If it's a big enough number, we might dig in a little deeper and say, no, we disagree. This is something they have to wear. You know, they have to wear clothes to deal with their inventory. Otherwise, down the hall, somebody down the hall that you work with is going to throw it out. So we're trying to be careful with it because since this is kind of the first wave that they're starting to audit, we don't want to be the test case for everybody. So if it's something where we think another client might be a bigger deal with, we'll fight for it in this case. The client in this case just kind of was like, you know, let's just, you tried, thanks, but let's just get this done and over with. State notices. I cannot tell you how many state notices we've got. I lost track. It kept me very, very busy over the summer. I would say without hesitation that about 90% of them were incorrect. We actually just hired somebody who used to work for the state, and she will even admit, basically what happens is you file your return, it goes into a computer. The computer doesn't like something, it spits the notice out, and those notices are automatic. We had one client that they were a low-income housing project. In the state, you get a deduction for it. All your rental income gets excluded. They had about $1 million in rental income. We got a notice. They, for some reason, took their $1 million adjustment and knocked it down to $100,000. I'm going, well, that's odd. And that's right off of the federal return, which they have a copy of. So I looked. Computer literally dropped a digit off, dropped like the last zero off. I called the state, and this is one of those funny moments that gets me through tax season because this was like March of last year. Our groups were pretty busy. Called them, and you hear the computer typing. It's like, well, let me take a look. And all of a sudden, the state employee goes, oh, dear God, no. Oh, this is just terrible. This is just completely wrong. And I'm like, so you'll fix it? And say, oh yeah, we're really sorry. And it just made me laugh. I'm like, I had to spend, you know, it wasn't long, but I still had to spend 25 minutes figuring out what the state did. Another 20 minutes on the phone with the state. By the time it's all said and done and wrapped up, that's an hour out of the day. And it was for something that could have easily been preventable. The state's gotten better on notices, but they're still not quite there yet. They're still learning it too. So if you get a notice, don't assume they're right. Don't automatically pay the tax. Now, if the tax adjustment is $5, and you'd rather just send it in, you know, that's up to you. But some of them have been big enough where, I mean, they affect, because we're getting them from 2008 still, so it affects your 09 return, 2010 return, 2011 return, especially if you have a credit carry forward. And that goes the same thing with the IRS. Don't assume it's right, okay? Always take a look at it. You know, if you have a CPA, yes.
The assumption, when I sent mine in last year, they actually turned around and sent me a letter, but I still needed to send them in $2.83. And I sent that in 6 weeks later, they sent me a check for $649.
Is this the state or the IRS? Okay. The problem with both the state and the IRS is that there's a bit of a delay. We had a client not report, they didn't give us some stock sales that they sold during the year, and this was last year. Well, the IRS will match up what they get, their 1099s versus what you're reporting. If you don't report something, they'll give you a notice, And they'll adjust your tax, as they'll adjust their bill. IRS always assumes that when you sell a stock, you've got it for nothing. And it's also automatically short term, which means you get your ordinary rate, you don't get the capital gain 15% or 0% as the case might be. So we had that happen. So we actually had to send in an amended return, sent it in. Well, about a month later, they got another notice that said the client still owed like $200 instead of the $25,000 or whatever it was the IRS thought they owed. We actually got a letter that said, "Thanks for your check," and I'm paraphrasing here. Where's the rest of it? And that again was a phone call to the IRS, and it was just a matter of it just takes them time to go through their, we sent everything in, well, the return's got to go somewhere else, so they send it to that office. So it takes a lot of time for the computers to catch up, and they were in the same boat where I think the client's getting like a $30 check back. So that's another thing with the state. I mean, the state, dollar, doesn't matter. You get a notice for a dollar adjustment, you want to call them up and say, how much is